Today, welcome to our series on how to develop a business plan, and today's topic will be discussing revenue. My name is Malusi Maheta, and enjoy the lesson. Today's topic, we are discussing revenue. Basically, revenue or sales, as sometimes is called, is the money that the business earns for providing goods and services. It's known that when you establish a business or when you set up a new venture, the main thing is to make money. And you make money by generating sales. So you must have people or customers that you will be able to sell goods and services to. So that's what we're discussing today. What is sales and how do you determine your sales, and how do you determine or identify the market that you'll be servicing? Because sales is a very, very important component of setting up a business. So sales is critical in a way that for you to set up a business or determine if the business is viable, you need to know that you'll be able to generate sufficient sales or enough sales to make your business viable. You can generate sales, but sometimes the sales, they don't convert into profit. Not all sales are profitable. So there are certain costs that you're going to incur. There's infrastructure that you need to put in place for you to generate those sales. So what is important is for you to identify the sales that will make your business profitable. So there are different types of sales that you can take into account. Some businesses are into manufacturing, where they're selling goods and services, or goods mainly, goods that they produce. And some businesses are in services, like your bank, your consulting businesses. They're not selling physical goods, they're selling services. So you can generate sales or revenue from different type of activities. But the main type of sales are, one is the sale of goods and services. And on the other side, it's more on services. And some business model, you can make money from selling goods and services, or you can make money by selling goods as well as make money by servicing. So you find that you are manufacturing equipment, you make money for selling equipment. But those equipment might need to be serviced. So you will also make money by servicing those equipment. So you need to decide on the business model that you're gonna implement, so that you know what will be your sales revenue streams. So as I said, that you can have both, or you can focus on one, on manufacturing, or if you are a service business, you can focus on services. I'll go a little more detail in terms of the sales from sale of goods and services, and then I'll get into the revenue or sales on providing services. So when you're selling goods, basically your sales will be the quantity of the goods that you sold multiplied by the price. That gives you your revenue figure. So depending on the type of business that you are in, some businesses, they make sales every day, every minute. Some businesses, they make sales once a month, or some once a quarter, depending on the size of the business and the type of products that you are selling. Your sales are the quantities of the goods that you are selling multiplied by the price of those goods that you sold. So you'll get your revenue amount. But your revenue amount is not in isolation. You obviously need to produce the goods and services that you'll be selling. Either you produce them or you buy them. So there is a cost to it, to say these goods that I sold them for this price, and the cost of producing or buying those goods is so much. Then you get what is called gross profit. And for you to operate as a business, there are other overheads that you will have to incur, which includes your salaries, if you are renting of the property, and other costs that are associated with your business. And then you're going to get your bottom line, which is your profit. So as I said earlier, your sales is the top line, is the first transaction that happens in your business, and that is not your profit. Sales is not profit. You have sales, which I told you how you calculate it, and there are costs that you're going to incur in between, and then you get to the profit. That's how you determine the profitability of your business. So when you're doing your sales projection, you need to know your market that you're servicing. And in terms of the consumption of that market, how many goods and services does this market consume averagely per month? And then you take that, you multiply it by the average price of those goods and services, then you get your monthly revenue or your monthly sales. So when you're selling goods and services, that's how you determine how much your sales are or your projected sales. Or if you're looking at maybe your management accounts or your financials, that will be your revenue that is reflected in your income statement. It will be the total goods that you sold for that specific month multiplied by the price of those goods and services. That gives you the revenue. Then you can look at your revenue per month, or you can look at it per annum. Per annum, it will be all goods and services that you sold multiplied by their price, and you get your revenue per annum. That's how you determine your revenue or your sales figures for your business when you are selling goods and services. And now we're going to look at the sales from services. Sales from services is you don't have a tangible goods that you are selling. There's nothing tangible. There's nothing necessarily that you're buying. You're generally selling a service. It's like your bank. They charge you bank charges, which is the service that they provide to you. But there's no quantifiable cost that is associated to that bank charges necessarily, because it's a service. So when you are in a service business, you need to know how many transactions that your customers will be able to buy from you. So if you are a consultant, you need to know if maybe you are developing business plans. When you're doing your projections, you determine how many business plans will you be able to develop per month, and then how many will you be able to sell to your customers per month. So in terms of determining for that service, you determine how long it's going to take you in terms of developing a business plan. You determine the maximum that you can produce in terms of business plans for that specific month. And then you take into account the number of customers that you'll be able to service. So in terms of when you're determining your revenue for that month, it will be the number of services that you'll provide to a client, multiplied by the number of clients, and you multiply that by the price that you charge the customer for the service that you're providing. Then that will give you a revenue for a service business. As I said earlier, sometimes businesses, they have different type of revenue. You can have both sale of goods and services at the same time. So when you are projecting, then you need to be able to project what will be the price, how much will I make for selling goods and services, and how much will I make for providing your services to service those clients. The total revenue then will be the combined figure. You will take the revenue that you make from the sale of goods and services, and then you add the revenue that you're going to make from services, and that gives you your total turnover or your total sales. So when you say revenue, you take different products and then you add them together in terms of how much they generated, and then it gives you your total revenue. That's how much the business would have generated from supplying goods and services. And that's very important, because when you're doing the projections, because projections are the guiding tool that will show you if your business will be able to generate sufficient revenue for it to be viable. And there's also another type of revenue. Sometimes they call it non-operating revenue. The revenue that, or the income that will generate, not from providing your core goods and services. So let's say you are manufacturing and you are servicing the equipment that you manufacture. So you're going to make sales from selling those goods and services, and you're also going to make sales from servicing those equipment or those goods and services. So that's the main revenue. That's operating revenue. But once in a while, you can sell maybe your equipment. You can sell that. Sometimes you get interest from the bank. If you have a bank account, if you have a positive bank account, the bank pays you interest on that. It's also part of revenue, but it's normally called other income. Even though the business is generating that income, it's not necessarily regarded as the operating revenue, but is called other income. So a business can generate income from operating income, and 2, from other income. Let's say you have the business got investments, it sells old equipment, or sometimes you auction certain things from the business, or you make money from interest. That makes part of other income, not necessarily your operating revenue. And when you're making projections, the important part or the important component is your operating revenue, because that's what will determine the viability of the business. So when you're doing the projections on business plan, you need to look at your operating revenue. Focus on your operating revenue and not on the non-operating revenue. Another thing that you need to keep in mind when you're looking at your revenue, remember, revenue is not the same as your cash flow. So cash flow is the money that you receive in the business. That's cash money that you receive. But with revenue, sometimes you sell to your clients on credit. So that money wouldn't be money that you have received, but it will be, you would have supplied those goods and services to your customer. Then you account that as part of revenue, even though you haven't received that money. So you need to keep in mind that when you're looking at your financials or your performance, you need to be able to separate between your cash received, which is a cash flow issue, and your revenue. A revenue is the money that you not necessarily receive, but you have earned, meaning you have supplied the goods and services, but your customer hasn't paid you. You recognize that as your revenue because already you have transferred the risk and the customer has accepted that they owe you. So legally, then you have a right to raise that as revenue. So when you're looking at your operation, look at the revenue that is being generated in the month, not necessarily the cash flow that is being received, but the revenue that you have generated. If you supplied people on credit, that revenue must be accounted for in the month that you sold those goods and services, not necessarily in the month that you receive your money. Yes, if you receive the money in the same month, then perfect. But even if you supply goods and services on credit, you account for revenue in that month that you supply those goods and services, not necessarily when you receive your money. As I said earlier, that you have different types of revenue that you can generate. And again, it also depends on your strategic objective or your business model that you have developed in terms of your revenue model. So sometimes there are businesses that they supply certain goods and services at a discount or for free with the intention of generating money from another service or another product. I'll give you an example with, let's say, Google. Google, they provide a search, is a search engine, but they're not necessarily making money from search. They're not charging you for you to come into Google and search that, search for whatever that you are searching for. But it costs them money for them to provide you with that service. But they don't charge the end user. They make money from advertising. So the people who advertise on the page are the people who are generating revenue for Google. So when you're developing your business model and you're doing your revenue projections, remember there are certain services that you might provide that you are not charging your customers for. So that you can account it as revenue. It's just the cost center where you incur the cost to provide that service, even though the customers are not paying for it. But your revenue then will come from advertising if you are Google. And other businesses like your McDonald's, they have certain products that they are selling which are not necessarily profitable or highly profitable. They are selling that product to bring people into the store. Once the people are in the store, then they might upsell them to buy other products within the business. So when you're doing your sales revenue, you need to know your revenue type and the type of services that you're providing. So that, in terms of, as I was saying with the McDonald's, they call it a cost driver, which that revenue, like let's say your Big Mac, or your kiddies meals. Those are the revenue drivers for McDonald's. They're not making a lot of margins on them, but those are the products that they use to attract customers to come to McDonald's, and then they upsell them. So when you're looking at your revenue, when you're doing your projections, you need to be able to identify which revenue is your revenue drivers and which revenue is highly profitable, so that you understand the difference. And then when you project the revenue accordingly, with that understanding in mind, that sometimes you have products that you're going to push as your revenue drivers, and then there are other products that will be more profitable. So when you're doing your budgeting, or when you review your revenue in terms of performance, keep that in mind, that there are certain goods and services that will not be as profitable as the others. And in summary, as I said, that there are different types of revenues. One is the main one, the popular one, is sale of goods and services, which is you sell a physical product to customers. You take the quantity of the product that you sold, multiply by the price, then it gives you your revenue. Others are services, which you're providing something that's not tangible. You charge for the time spent on providing that goods and services. Let's say a consultant. Consultant will charge you, or if you're a consultant, you'll charge a client based on the time that you spend in developing the solution that you're providing for that particular client. So it's a little bit different. And then you also have rental income, which is the service that you provide. Let's say you have a property, or you're a property owning company, and you rent out the properties to your client. So that's the income that you're going to generate from rental. You're not necessarily providing them or selling them the property, but they are renting the property from you. And another type of revenue, it can be your copyright or intellectual property. Sometimes people, like your actors and all that, they have, or the movies, they sell the copyrights to people to show. They don't sell the actual movie, but they sell people the rights to use the product, or the rights to use the service that they've developed. So they have a copyright and intellectual property on that. So they just generate income. They develop it once, and then people are just using it, and then the company generates income from it. So that's another revenue model that you can have. And sometimes you have a project management type of revenue, where you're just managing a project on behalf of a customer. Let's say you are a project manager for developing a complex. You don't own the complex. You don't provide any goods and services to the customer, but you're managing that property on their behalf, or you're developing that project on their behalf. So that's another type of revenue that you can generate. So there are many different type of revenue that you can generate as a business. You just need to understand the business model that you are in and the type of revenue that you're gonna generate. Now we're gonna give you practical examples on our movie case studies. Now the first one will be, we'll look at the McDonald's, their revenue model. They generate income from selling your food, like fast food, your burger and chips, and they also generate income from rental, because McDonald's build the stores, and the franchisees then rent from McDonald's, and the franchisees also pay royalties. So it's another revenue stream for McDonald's. They make income from franchisees paying the royalties for them. So those are the main revenue models for McDonald's. Is for selling from the own stores, where they're selling you burgers or goods and services. And the second one is from the rental of the property that the franchisee are operating from. The third one is on the royalties. That's the first case study. And the second one is on AUI. They're making money from supplying government with goods and services, or with goods, military related goods. So that's their revenue model. And the Auckland A's, they're mainly making money from advertising. People who are sponsoring the club, people who want to advertise in the stadium. And then the other revenue that they are generating is from the gate takings. So they mainly have two revenue streams, and the other one is coincidental. It's not necessarily their business model, but when they are selling players, they make revenue from selling players. Now here is the case studies going a little bit more in detail, and we'll discuss it after.
Revenue. Revenue segment is the market slice that your organization is targeting. Broadly speaking, there are three market segments that an organization can target. Individuals, households and individuals. In this market, individuals are consumers. This market is called business to the consumer, B2C. Business, servicing corporate. In this business, the customer is another business. This market is called business to business, B2B. Government sector. In this market, the consumer in this case could be the government or citizens. Government as a consumer, and the market is called business to government, B2G. Services paid by government for the benefit of the citizen. The market is called business to consumer, B2B2C.
McDonald's is targeting business to customer B2C and business to business B2B. Franchisees, they are more B2B. The franchise are business on their own. McDonald's also have their own store where they are servicing individuals, business to customer B2C. McDonald's also get a cut on the raw material input that are supplied to the franchisees. This market will be business to business B2B.
The key market segment of the A's is mainly servicing individual fans. This market is called business to consumer, B2C. The A's also have corporate clients. This market will be business to business, B2B. This client will be in business that wants to sponsor the club for marketing purposes and to pay for advertising during the games.
AY supplying one gunman, the Pentagon. Their market segment is mainly government. Government as a consumer, and the market is called business to the government, B2G. Government consists of spheres. It can be the national government department, provincial department, and local department. All government spheres follow similar procurement processes and are generally the same.
Complete the assignment. Compare how the topic is addressed in the three movies and rank them according to your preference on how the characters and the organizations dealt with the topic and motivate your ranking, 1 being the best and 3 the worst. Analyze this topic and its applicability to your situation and industry. Write up your analysis to meet the requirement of the industry you're operating in. Update the relevant section in your business plan.
As you've seen from the case studies, there are different business models that we can develop as an entrepreneur. You just need to make sure that you know your revenue stream. The McDonald's revenue model is clear. What changed everything for them is for them to develop their own properties where they are making not money not only from the royalties but also from the rental that the franchisees are paying, which is what sustained McDonald's, which it made it one of the largest property companies in the world. And then on AUI is clear. They're just making revenue from supplying government. That's one revenue stream that they are focused on. And then on the Oakland A's, they are making money from gate takings, from advertising and sponsorship, and selling players. Those are their revenue model. I hope you enjoyed the lesson. That's the end of it.